Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, August 5th, just after the close. What did the equity market give us this week? Probably just what we needed, right? We have had that nice explosive move off those mid-June lows, gaining momentum throughout July, and then got a good chop to the market, some back and forth action this week. You know, we've noticed over the last month or so, as I'm sure you have, growth has taken the baton from value. It will be interesting going forward to see if growth can stay strong if rates move higher. They've been a beneficiary of rates falling. Moose has gone over continually how that 10-year, for example, has dropped from 350 to 260 before backing up today. And that gave a bid to growth. So in terms of what we'll be looking at going forward, probably staying barbelled there between growth and value until one can really cement leadership. And that, in terms of what we're looking at in the market, that gets to the psychology of the market. We want to make sure that we're staying flexible in what our decision making is going to be. This gets back to psychology in the market. And what I wanted to do is share two charts with you today, specifically talking about trying to stay on top of your psychology in the market. If we look back to June 17th, what you're looking at right now is a chart of sectors, 40 different sectors, and what percent of the stocks in those sectors are trading above their 10-week moving average. 10-week moving average is a popular term, a popular analytical device in trading, just to offer whether a stock or a sector is strong or weak. When we look at that chart, we're seeing extreme weakness. You know, we look at 40 different sectors trading between 0 and 10 or 15%. In other words, only 0 to 15% of the stocks within those sectors were trading above their 10-week moving average. Very rare to see this. And we spoke to that back on the 17th. That was a Friday. Probably noticed I was miserable. The one thing we did reiterate, though, is that type of action creates opportunity. You don't have to be impatient and be a pure buyer there, but upon the reversal from those levels, you often have opportunity. The second chart shows where we are today. There's those same 40 sectors and where they currently sit in terms of the percent of stocks within the sector trading above their 10-week moving average. Much healthier, much healthier. So if you were able to stay calm, to look at opportunity versus fear 6 weeks ago, you've been able to put capital to work or ride out in current positions a nice bounce here. Now, what we see going forward, we'll keep an eye on this. I think we'll see some more chop, some more back and forth. Very difficult in a market with volatile interest rates and inflation in the headlines every day, not to mention Russia and Ukraine and China and Taiwan. Very difficult to imagine we can get a sustained straight up bid from here. And it would be very healthy for the market to continue to chop and give us opportunity in different sectors. In terms of some of those names we shared 3 weeks ago, very nice movement in those names. One of the things that they all equated to or had in common was they were trading off of higher lows, something we look at. Higher lows means supply or selling is drying up in a stock or sector. So those are the things we'll continue to look at. In terms of next week, we have a CPI print coming. Should be plenty of volatility in terms of the bond market, which may spill over to the equity market. We do have cash throughout our strategies, so we're prepared to buy target positions at levels that we're comfortable. So that's it on the equity side. Now we're going to toss it over to the Moose, who's taping remotely this week.
Hi, I'm John Mousseau, Director of Fixed Income and CEO at Cumberland Advisors. It is Friday afternoon on August 5th. Surprise in the bond market today. Non-farm payrolls up 528. Expectation up 250. Bond market took it on the chin today. When you look at the week, you're looking at basically a 2-year at a 325, a 5-year bond at a 297, 10-year treasury at a 284, and a 30-year treasury at a 306. Those are up anywhere from 35 basis points in the shorter end up to about 6 basis points in the longer end. But a lot of the damage came today from lower yield levels. Does it change much? No. It is one number. What does it mean? It means the economy continues to improve. It means that people who didn't have jobs in June took jobs in July. That is a good sign. If you look at other things like wage inflation, somewhat moderating. If you look at things like unemployment down to 3.5%, from 3.6. So at the margin, improvement. Probably keeps the Fed on pace for the 75 basis points. Next meeting, maybe 75 after that. Clearly their work is not done. That yield curve I described is the same shape it's been for a while. Negative yield curve out from 2 years out to 10 years and then climbing out through 30 years. Muni yields, unchanged for the week. Again, they were basically, cheapened up today a little bit, but net for the week, 10 and 30-year muni yields hardly changed at all. Big difference. The deals that came this week in muni land, hugely oversubscribed. And I don't mean 3 or 4 times oversubscribed. I mean 15 to 20 times oversubscribed. So buyers are back. That can be measured in a couple of different ways. One, those oversubscription levels, which are off the charts. And also the fact that you see bond fund inflows again for another week. I think that's 2 or 3 weeks in a row. Very good sign. We'll see whether it keeps up because we know how dramatic the outflows were earlier this spring. But that is a good sign, and it seems like the market has embraced that 4% muni yield and realizes it's not going to last. And if you can remember back towards the middle to end of June, those numbers that were at 4.5 to 4 3/4. Well, now you can still get 4, but boy, you gotta work for it and look for it. But those deals that came above 4 were widely oversubscribed, and a few of them were priced through 4%. So the muni market is definitely making that turn that we thought it would make, and it's certainly a welcome turn. When you look at other things for next week, we're going to be looking at the CPI number. That comes out Wednesday, very important number. If you look at some other numbers back this week, some of the themes haven't changed. If you look at what they call the ISM number, which basically reflects prices paid by purchasing agents, moderated down, surprisingly lower. That fits into the general theme when you look at things like commodity prices or lumber prices or house prices, which seem to be moderating a little bit. So the same thing we've talked about hasn't changed because of this basic number today on jobs. And our outlook is that the 10-year bond will probably move in this range from 275 to a 325 back and forth. The longer it stays in there, the better other fixed income products can improve themselves. That includes munis, that includes things like corporates, it includes things like taxable municipal bonds. So we'll be watching the CPI number next week, and we hope you all have a great weekend. Thanks a lot.
Thanks, Moose. Great info. And by the way, Moose and I recorded a video reviewing the Q2 positioning in our fixed income and equity strategies and what we think we may be looking at heading into Q3. You can find the link below to those videos as well as on our YouTube channel. Don't forget to like, comment, and subscribe so you can follow along with any and all of our weekly videos. Have a great weekend.